Hello, this is Jeremy North with your educational and economic update for October of 2022. In this month's video, I will discuss major headlines that influenced markets in September and economic and market events that we were looking at to influence October and future returns. Please stay tuned at the end of this video for the always exciting required disclosure statement. Well, in September, the U.S. stock market had its worst monthly performance since March of 2020. The S&P and NASDAQ composite had their third straight quarterly losses for the first time since 2008 and 9. And the S&P 500 posted its worst September loss since 2002, down 9.3%. The S&P 500 has lost 12% in the past 3 weeks due to concerns about inflation, monetary tightening, and the effects on global economic growth. With 1 quarter left this year, the S&P 500 closed the month of September down roughly 25% for the year. The NASDAQ stocks, down 10.7% in September, are down over 30% for the year. For the NASDAQ index, which is mostly growth stocks, its steep losses this year are due in large part to rising interest rates. Increasing rates makes future growth profits from companies less attractive. Analysts who focus on earnings growth say that estimates are now for earnings to be around 4.5%, down from 11.1 estimate when the quarter began. Again, the catalyst for these dismal performances was the global economy showing signs of slowdown, but again, also largely due to the Federal Reserve continuing to try and tamper down inflation by increasing the federal funds rate another 0.75% to a target range of about 3 to 3.25%, and suggesting more of the same increases in the coming months. This would put the Fed rate at approximately 4.5% by year's end. The federal funds rate is the rate that banks lend each other money, and it sets the tone for all short-term lending in our country. Along with our Fed, international central banks have also been raising lending rates in an attempt to combat overall global inflation. While prices have remained high, economists worry that the Fed may be too aggressive, which could cause a deep recession. With the Q3 earnings reporting season just weeks away, companies have been warning investors about the negative impacts of higher interest costs on their profitability. Also adding to economists' worries, the average 30-year mortgage rate is at its highest level since 2007. And the U.S. economy contracted by 0.6% in the second quarter, which followed a 1.6% pullback in the first quarter. So this aggressive funds rate increases have also caused the U.S. dollar index to move to 20 years high, which could be seen as a good indicator for Americans, but the stronger dollar makes it more expensive for foreign buyers to buy most oil. It's priced because it's priced in dollars. A stronger dollar makes crude oil more expensive for foreign buyers, dampening demand. U.S. WTI crude index oil ended the month down 11% at $79.49 a barrel, and down nearly 25% in its third quarter, its first quarter loss in over 2 years. With all these headwinds, we expect the market to remain volatile and unpredictable. This is why our general overall retirement investment strategy has been to keep a portion of our clients' portfolio protected from the market. We do this because we understand how volatile the market can be, and having a sizable portion in protected accounts benefits your overall portfolio volatility, stabilizes your retirement income, and can put some certainty in this really uncertain environment. As always, we are diligently assessing the economic and political implications for your portfolio. Should you have any concerns or questions, or would like to discuss your personal situation, please give us a call. With all that being said, here's the disclosure I'm required to read. While we believe this information in this report is reliable, we cannot guarantee its accuracy. Opinions expressed are subject to change without notice and are not intended as investment advice or solicitation for the purchase or sale of any security. Please consult your financial professional before making any investment decision. Investing involves risk, including the potential loss of principal. No investment strategy can guarantee a profit or protect against loss in periods of declining markets. The indices mentioned are unmanaged and cannot be invested into directly. Past performance does not guarantee future results. Thanks again. Jeremy North signing out for the month of October. I hope you have a great start to your